Hi, thanks for tuning in to our Practical Nerds weekly podcast. I'm Shubh, and together with my partner and co host Patrick, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. So, Patrick, we're back after a week. How have you been?
Great. And it's always good to be reminded by our intro what we're actually doing. So that
I
serves.
know, right? Because obviously we did nothing since the last episode, and what a way to round out the week.
And we're completely unprepared. So actually, the intro for me is just a reminder of what my job is.
I know, exactly, exactly.
Good. No, but I'm glad you recorded the intro. Maybe we should at some point add some music in the background, but we're still, we're on our way to leveling up.
I mean, we should make sure it doesn't go from nothing to something. You know what I mean?
Oh. Is that the same as saying that, hey, at some point my scrappiness is my trademark and I don't want to
Mhm.
change being scrappy?
Yeah, maybe.
Okay.
Yeah,
Okay. Well, very practical.
indeed. Hey, so
Nice.
on this topic of I guess not nothing, but something. And I guess that's as good of a transition as I'll manage.
Well done.
We have an interesting topic that we wanted to discuss today
What's that?
about becoming net profitable or the power or the value of being net profitable in construction tech.
I mean, is that a real thing? People, founders, startups raising a lot of money like that's what our industry is known for. But
Yeah.
what about being net profitable? So maybe to kick folks off, we've actually run numbers. So out of the 60 founder teams that we have partnered with, 13 actually are net profitable or have been net profitable before. So in other words, over 20% of
Yeah.
our portfolio, which is Constru-Tech. When I tell this number to other investors, fellow friends, etc., they actually find it hard to believe that that can be done for early stage investments,
Hmm.
and especially in Constru-Tech. So
Yeah.
how about we kick it off maybe with anonymized examples, Shub, of companies
Hmm.
that actually one of them I think we've shared, so that's probably not anonymized, one of the
Yeah.
13, but that could be quite interesting for Constru-Tech founders and experts in the industry alike. It's just sharing these examples of projects that actually are net profitable.
Yeah. Indeed. Before we get into the specific examples, just to make sure we're all on the same page, and I don't know if you get asked this question
Oh,
as well, Patrick,
definition time.
because I certainly do get asked this question when I say, hey, net profitable. I often get a clarificative question of, oh, you mean gross margin profitable, right? Or contribution margin profitable, or like profitable at a unit economic basis, or maybe you mean EBITDA profitable, so on and so forth. So then I have to clarify, no, I mean like net profit after tax, as in that's the bottom line, right?
That question alone, the fact that you get asked this question tells you how much arm twisting there is in the industry of
Yeah.
making things look like what they aren't.
I mean, I'm sure you've come across decks where people claim, "Hey, we are profitable," but it's actually one of the other many line items that come before the bottom line, and that's what is being positioned as profitability. It's quite
My
fascinating.
favorite this year was a European solar unicorn that
Uh huh.
has a lot of depreciation and financing cost, and put out a big PR and said, "Hey, we're operating profitable, but before depreciation and financing." I'm like, "Hey, your whole business is asset financing, but
Yeah.
sure."
Yeah. 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 Right. So I think so. So that's the bar we have, as in the bottom line in the P&L is a positive number at the end of the month or the end of the year. An interesting composition of the companies we found in our portfolio. Interesting geographic mix, firstly, across India, multiple markets in Europe, if I'm not mistaken, Patrick, and in Australia as well. Uh, Firstly, so that's an interesting geographic representation. A lot of them, or most of them, have something to do with either supply of goods or supply of services like
Yeah.
logistics or other supply chain solutions. Could be also providing a technology enabled conduit for accessing various services. Um, a couple of them also act as the business model in terms of its profitability. It resembles software businesses or SaaS businesses, but what they represent more is like a platform for transactions, but they as a platform make a very high share
Hmm.
as a fee of the revenues they generate, right?
Yeah.
um, and interestingly enough, one of the firms is super young as well. So in fact, it's never been unprofitable. I mean, that also describes a growth stage company or a very mature company. But there's another company which started off as being net profitable and has never not been net profitable. So also to, I guess, point out that even very early stage companies can be net profitable if they are designed the right way.
And I think so. Let's draw a circle around these examples you're giving, right? So within a sector like construction and
Hmm.
the construction supply chains, the value and what's being appreciated by the market and the customer is the outcome. Hey,
Hmm.
here's what I'm putting in place for you. Whereas the value of software is only getting appreciated, over time. It's increasing, etc. But the outcome has always been appreciated.
Yeah.
So the circle around the examples you're giving, actually across, I have to go back to the numbers, but I would say probably almost all of the companies in our portfolio that have achieved net profitability at some point is that they typically monetize some kind of transaction or service.
Yeah.
Whereas the SaaS businesses, one exception that you're mentioning, but that is also monetizing actually financial transaction, not
Correct.
just the SaaS revenue. So if it's just the
Exactly.
SaaS revenue, the path to net profitability tends to be longer. Now,
Mhm.
at the tail end, it can scale terrifically, right?
Yeah.
But I think that's the interesting insight about construction
Hmm.
as a
Yeah.
market here is that actually on services, on outcomes, you can actually achieve net profitability quite quickly.
Now, a lot of or some people listening to us, they might be wondering, hey, you're describing the transactions is the way to make profits. But yeah, I hear of all these e-commerce firms, quick commerce firms, so many other
Oh,
transactional firms burning through tons and tons, hundreds of millions of dollars or euros. How does that correlate with what you and I are saying right now in terms of transactions being the gateway to profitability? What do you think, Patrick?
well, I mean, um, you mentioned unit economics earlier, right? So whatever I do on a gross margin level needs to be so profitable in itself that the overhead below it gets covered multiple times. And so with quick commerce, that's a real challenge. I think
Hmm.
folks are following probably the news, so let me not double click on that. But it's been a challenge. Scooters 5, 6, 7 years ago were always reputed for having a similar challenge. I've never looked into the business, so I can't comment. Just saying, like they've been reputed for that. And an equivalent in construction actually have been so there have been quick commerce businesses in the US, in Europe, that try to deliver like small baskets, small average order values to construction sites within 2 hours. The businesses we have seen, similar issues, right?
Yeah.
So if you try to monetize on super slim gross margins, then of course the path to net profitability and doing that also repeatedly,
Hmm.
that can be a difficult one.
Yeah. I mean, the other interesting distinction that comes to my mind, I mean, in general, as a playbook in B2C commerce, for example, and many other successful companies across the world, be it in e commerce, ride sharing, food delivery, all of the standard consumer tech use cases, you see this phase of a great deal of build up of assets or build up of infrastructure, and then a great phase of marketing and user acquisition. And the promise is, hey, at some point you will win over the customers in a winner take all, or maybe there's two firms standing at the end, and that's how you make money.
Mhm.
And I guess there is a case to be made that for firms such as Amazon, even though Amazon, the profitability and free cash flow, it's a bit sketchy. It keeps going up and down a bit, so that it's debatable if that's a good example for what we're discussing.
Yeah, let's not comment on their tax thinking and investment thinking and
Exactly. So I think a lot of founders come with the mindset that, hey, this is the playbook we need to repeat in construction in order to eventually get to a large outcome where we need these enormous outlays to sort of build up awareness, drive some sort of customer acquisition, etc. But I think what we have generally found is the sales motion, if you will, the manner in which customers adopt, and your ability to monetize them, it actually has a very poor correlation. I wonder if it even has a negative correlation to disproportionate spend upfront, if you know what I mean. As in, if you in fact limit your spend and your what you build up to designing a product that is very specifically tailored to what the customer is demanding, and don't put all the bells and whistles, all the additional spend behind it, I wonder if it actually improves your odds of scaling better, which is different from how, for example, a lot of B2C consumer tech firms have been built. In fact, in real time, I'm thinking both within our portfolio as well as hundreds and thousands of firms we have looked at Fundamental over the years. If we have any solid examples of firms that have gone like the big bang approach, early stages, say seed, series A, maybe even a
yeah.
little bit later, and saying, hey, it'll eventually sort itself out, the business model or the unit economics. I think it actually never works out.
I mean, never is a harsh word. Would have to do a
True.
lot of
Yeah.
diligence to say never, but I think close to never is probably or is probable. I wish I could give this founder a shout out, but I'm actually not. So we chatted recently, Danish founder, and so what he's. But so the reason why I'm probably not going to give him a shout out, because I don't know if I have his permission to actually share what he shared with me.
Oh.
But it was darn impressive. It's a second time
Mhm.
founder, and he's now in the space of within construction. Helping construction companies organize their logistics. And there have been software businesses around for as early as 2013. If that's the earliest that I can remember, software businesses in helping organize site logistics and supply chain logistics for construction companies. And so this guy has taken a different approach. And he told me, I got a lot of flack for it. Like that's literally what he said, is from VCs, from under founder friends, etc., that I started with a service first, an outcome first approach, and then build the software as I go. But hey, I'm net profitable. I just encouraged him. And I mean, not that he needs encouragement. Very, very confident guy, and obviously successful, or apparently successful at what he's doing. But still, I still wanted to lend him encouragement in that this is the old school way of building venture. It was just forgotten in 2014, 15, 16, whenever this started, is that you actually raise money once you have something proven. And the ultimate proof is net profitability and the ability to achieve that. GitHub, people, I think people don't research these things always, but GitHub actually raised a 150 million US dollar round as the first round. But that was because they were net profitable.
Was that were they bootstrapped until then?
Yes.
Oh, that is mighty impressive. Okay.
Yes. So see, that's from a founder perspective, one of the things you can unlock with net profitability. You dictate terms.
I mean, there's this firm, Patrick, that you and I were recently talking about called Zoho, which actually has users all over the world. And a lot of people don't realize it's actually run from a smaller town or another city in India, bootstrapped almost up to $1 billion in ARR. Right? That's how large the company is. Right? So
Wait,
if you're
billion with a B.
$1 billion, right?
Bootstrapped.
Bootstrapped, right? And I think over its lifetime, several VCs of all kinds have tried, to find ways to enter the firm, but it's remained bootstrapped. And I'm not saying that is the way for every firm to grow, but there is a certain charm and something very endearing about that sort of a journey and the kind of options it creates, being highly profitable.
I mean, to do it into your entire lifetime, it will take you longer
Mm-hmm.
to get there, just because you're not raising external capital in order to accelerate something. So it
Mm-hmm.
only works in markets where you really feel like you're not going to encounter meaningful competition, new entrants, etc., and where you feel like you can have 15, 20 years or
Mm-hmm.
longer to build out that moat and that business. But
Yeah.
these pockets do exist.
Yeah. I mean, look, there's also a middle ground, which I think most of our net profitable firms fit into. It is that they start off being net negative, although with models that imply that they have a path to profitability. But they find a way to become net profitable fairly early in their lifetimes, maybe within the first year or two, even. And which is different from, say, bootstrapping all the way, but maybe raising one round or two rounds, and that gets you to profitability.
Makes sense.
I think so. The interesting thing is, quite often when I have discussions like this, and I wonder if you've heard something similar. Oftentimes, I hear people reacting as if we are somehow limiting our options by the business being chosen to run in a net profitable way.
Completely wrong. You're opening
Exactly.
options.
Correct. And by the way, I would love to have that discussion with you, because I think that is something which not enough founders and to my surprise, sometimes not even enough investors appreciate. What sort of additional options open up when you become net profitable as a business?
I mean, we've already touched. So, okay, so what happens when you do that? So one of the things we already touched upon is you dictate fundraising terms. Like
Hmm.
that's it's obvious when you hear it, but oftentimes, I feel like it's not obvious
Hmm.
to folks, especially when folks think, "Oh, I need to build a product first, etc." Well, sometimes the service is the way to the product. That's just
Yeah.
another way. Obviously, doesn't work if you're doing robotics. Okay, so that as an example, so that one
Yeah.
is you can't start net profitable with a service in order to build a robot. So that is a bit, but in construction value chain in terms of software, it does work more often than you believe.
Hmm.
The other thing that it opens up when you're being net profitable is that you tend to be more scrappy and find out that you can make do with less just naturally. It
Hmm.
gets encoded in your culture. So the scrappy portion that oftentimes when you raise a lot and it gets lost, when you establish net profitability early, it's much more robust in your
Yeah.
company DNA. So I think that's
Hmm.
a second thing that multi-time founders have a feeling for, but like when you're still on your first journey of building a company, that's one of the more hidden or opaque things that is worth pointing out, really.
Hmm. The other interesting thing I realized, and this, to be honest, I just realized by through anecdotal examples, not through any real insight, I must admit, is when you're net profitable, very different kinds of sources of capital open up to you. More traditional capital sources, which usually are reserved for corporates, larger public
That's
companies,
right.
things of that sort, like low cost debt, for example, and various other structured financing solutions. A lot of these are simply just closed altogether
Yeah,
for the vast majority of venture backed firms, because the financials just don't hold up to the standards that these debt providers are looking for.
that's right. And then that's non-dilutive. And by the
Exactly.
way, just to call it out, you're not talking venture debt, which can come with a lot of strings attached. You're talking classic debt.
Yes, from
Yeah,
banks and etc. Yeah,
yeah.
yeah.
So that's non-dilutive. And then another one, I think, in terms of optionality, founders on the software side tend to encounter with an AEC also the question, yeah, but I don't want to get into a contract with you just yet because I don't know if you're around next
Hmm.
year and if I move my entire data to you. So founders in the SaaS space, open source space, and I think open source probably one of the prominent ones there is, yeah, but how do you make money? How do I know that you're still around? That's something
Yeah.
that founders in these spaces tend to encounter? Well, if your answer is easy, I'm net profitable and I make money, I don't burn money, discussion is over. And
Yeah.
so that opens up customer contracts with large customers that have that level of concern. So,
I'm sure there's people listening to this and saying, "Hey, but what does it actually mean in terms of what does it mean? Like having austerity measures? Does it require certain kind of sacrifices? What would it actually entail for a firm to become net profitable?"
so I liked how this must have been a while ago, but a top hire by one of the portfolio firms that I've partnered with came from like an asset leasing unicorn. And so he taught me the dolphin theory. I had never heard of it before. To
Okay.
this day, I've never heard of it again. I don't know, Mitya, if you're listening, if it's your theory or I don't know, you maybe just read different things than I do, but it really stuck with me. So the way Mitya explained this to me, the dolphin theory is that the dolphin comes up for air right before a financing round. And for air is I prove I can be net profitable. I prove it to myself. I also send a signal to my organization that this is actually something that is a valid objective for us and keep that in mind. So the dolphin comes up for air. Based on that proof of being able to be net profitable, you raise at great terms. And then the dolphin dives under again. Okay, you hire, you make certain potentially sales hires, etc. Everybody knows in venture, after a financing round, the first few months, the KPIs tend to look different because you're onboarding people, you're training them. It takes a while to actually get them up to speed. The biggest way you can see that is on your sales biz dev team, AEs, SDRs, but also on the engineering side, your engineering KPIs typically go down as you ramp people up and you onboard them. So that's what happens the first few months after a financing round. So you go through that depth in the water, and then the dolphin needs to come up for air again at the next financing round. So from a company journey between financing rounds, I find that quite useful as a framework, this dolphin theory. You hire, but then you need to stop hiring. And then you need to prove with the hires you made that you actually can become net profitable again.
Yeah, I like that quite a bit. I think uh, I also think ultimately, if you're so quite often we forget, and I think we've had this discussion a few times where I think in a few years in between we've had a bit of change in mindset where the objective many a time, and I think investors are equally guilty of this, unfortunately, the objective didn't become where the outcome was a fabulous company. The objective became how can we get the next round of financing.
Yeah. You're
So
talking 2019, 2021.
yeah, I mean, I think the signs were already there before that. We saw the worst of it in 2020, 2021, the first half
Right.
of 22, but the signs of this sort of behavior have been there before as well. And I wonder if, the natural climax of that sort of mindset is a big blow up and a big time asset correction as we are in the midst of right now. And maybe there's a chance to this is actually an opportunity to think, hey, you've got some capital now, or maybe not if you're a bootstrap company, but given the resources you have now, how can you build the best version of the company you have, right? If this is the very last round you had, what is the best company that you could create with the resources you have, right? And now it may
I
seem
love
like a
that.
very dire situation to put yourself in, but I think again, and this is like a truism, and we have heard it so many times, but sadly not practiced enough. It is truly remarkable how powerful just constraints have on our ability to create great outcomes. In if there's excess,
Very true.
overabundance of everything, you actually the probability of either a mediocre outcome or a bad outcome increases quite dramatically for
If you
several reasons.
consider, oh, sorry, Shub.
Yeah, for several reasons, but I think if you work with constraints and if you put yourself in the mindset that this is the last round that you'll have to create a great company, it is quite magical what that could lead to.
Absolutely. If you consider, I mean, there's two sources of cash really in a company, unless you start playing lottery or whatever. It's either your investors or your customers. If you consider your investors your best source of cash, then you have a flawed mindset. The
Yeah.
best source of cash are your customers. The only reason why you raise cash from investors is to access more cash from your customers. It's the only reason. Once you start
Yeah.
thinking about it that way, to your point, and you say, hey, maybe I never get more investment from my investors. The only source of cash flow for my business is my customers. And what is the
Yeah.
best company I can build for that?
Yeah. I mean, by the way, I mean, a founder I deeply respect, and I'll keep it anonymous because I don't know if it points in a specific direction or whatever. But he once told me that in general, when interacting with investors, it is quite sad that pretty much everyone will have a point of view on how you get the next round of financing done. But when
Uh,
you, for example, ask them, hey, how can I become a truly respected, publicly listed firm doing what I do? There's hardly any opinions expressed. In fact, most of the time, nobody has a point of view on that, which is
well,
quite fascinating thinking about it. That because for us, the I guess the most desired way we would like to exit is eventually when companies go public, and frankly, not even then. Even sit it out until you realized extracted the most value. But it's disconcerting how little thought goes into what that outcome entails.
I mean, okay, this, I don't want to sidetrack us too much, but I need this little dig at our job and our industry. So that's what happens when you bring, sorry, kids from other jobs that are charismatic, have the right academic logos on their resume, can communicate eloquently, and are good at relationship building. If you put them into investor jobs in funds that raise too much money, and then they are the ones serving on the boards for
Yeah.
their investors. That's what you get, is people who have not only not been through that journey, who actually don't even have that mindset. Because what we did in those years, 16, 17, 18, 19, 20, 21, is exactly putting those people into investor positions, but also board positions, and giving them the impression that the entire job is chasing the next deal, chasing the next financing round. Well,
Yeah.
if then you're actually instilling the gas state. I call that the gas station mentality. So you're always going to the next gas station to keep filling up, and
Yeah.
the empty tank. So that's how we encoded this gas station mentality. Also, like we're culpable here. We're
Yeah.
also to be blamed. So I think for founders here is just demand that you're the partners that you bring on as shareholders, that they send the most experienced people to work with you.
But tell me now, if there might be founders listening to this who say, "Hey, either they've heard, or my investors are saying, hey, I need to grow, whatever, and it's this insane percentage over the next 12 months. How do I do it without, burning a tremendous amount of money? Doesn't seem doable with by limiting myself to a very small set of resources and trying to be net profitable."
Are you hearing that a lot though? That still investors are demanding insane
Not
growth?
right now. In fact, I would say, and maybe that's a topic for a different discussion. I have to say that it's probably gone a bit too much in the other direction, where people have retreated to the point of saying, "Hey, just keep alive, stay alive, just conserve cash, right? Growth is secondary, etc." Which I
Okay.
hear that. I think that's in my opinion that's way too overcorrected in the opposite direction, in a way where at that point you're alive, but you maybe are reducing your relevance or maybe becoming irrelevant as a venture backable business if that's how
Mhm.
you run it.
Yeah, I mean, okay, I'm relating to what you say. I also have these anecdotal or these anecdotes where I heard something similar. It almost feels like a pendulum. Like I
Mhm.
overcorrect an extreme uninformed position with another extreme uninformed position.
Yeah.
Luckily, though, that one, to that extreme degree, I have not heard as much. But in my regions, Europe, Latin America, the investors that I like to work with typically have a similar point of view as mine. Is that, hey, of course, like the benchmark is not being net profitable and 5x year on year growth. I mean, if you achieve that, then there's not going to be someone that is much better than you. but 2.5x year on year and net profitable, like that is like platinum standard if you can do that.
Yeah.
Of course, it depends a little bit on the baseline. So if you're like, of course, growing from 10,000 annual revenue to 25,000, okay, but I think that's implicitly understood.
Yeah, I would have to agree. I think the onus is on both investors, but also on founders to, I guess, weigh a bit and not think through this as like a one-stop journey, or hey, it's just like what do we do to rapidly race towards the next funding round and show some numbers, etc., which might be vanity or otherwise. The idea is, are you building like a truly great company that will endure and which you can be proud of, and what that looks like? It could take on a very different flavor, and frankly, both the investors as well as the founders have to stand up to uh, look at it clearly and then embrace what that mindset and that philosophy looks like. I mean, if everything comes together, you can have a magical combination of 5x or even greater growth at net profitability. We have seen those examples, but if you, I mean, that cannot be plan A with no other thought given to it. Um, yeah.
And so we've discussed the journey from, or we've hinted at the journey from, hey, maybe sometimes in construction, some businesses start actually with a great service business that they then transition into a software business. Do you have examples in mind of that?
Oh, you've got me at a disadvantage. Let me think on the fly.
Oh, don't worry, that was not my intention. But so from my side, so for example, in the workforce brokerage market, there's multiple examples of that achieve. So imagine the following model: blue collar workforce shortage, employers struggling to find talent keeps churning, they need to find more and more talent, and they struggle to attract them. So in comes a software-enabled broker that competes with the offline brokers, but just with a much more digital experience for both sides. Sources these people, monetizes on the referral fee. Multiple examples of these companies that actually achieve net profitability very early. It's just a very, very profitable unit economic type business, and then over time, these examples go more and more into a SaaS-like model. I say it's SaaS-like because the most advanced ones that I've seen are mostly a token model where you convert like the one-off fees into a package, a token package that gets pre-purchased. So it's not quite ARR, but it's a close equivalent in a software-enabled service type business. And that can be large companies. Okay, so the call to action to founders is, I was going to say, forget everything that VCs told you the last 5 years. That would probably be too extreme on my part, but like question everything that have VCs told you the last 5 years. I think that's a good advice.
Yeah, absolutely. I'm still dwelling on the question you asked me. I don't know why I'm drawing a blank. I'm sure there's examples that exist for
I
firm
mean,
success.
insurance brokerage is a service.
It is, yes, it is.
Maybe you have examples there.
I mean, there is one such firm that we're quite familiar with, which could transition from insurance brokerage to sophisticated products. I'm thinking, would that extend to software as well? Going with your specific question. I mean, I can definitely think of examples where firms start with a specific service and then translate to other services or other products packaged as services, and then it sort of becomes a moat where you're sort of the user or the customer is captive, and I'm using captive in a very positive sense, captive in that ecosystem, so you can monetize them through several means. It's not exactly software, but it does have software like aspects to how the user is captured. I mean, by the way, I really like, it's probably not a good example or not relatable specifically to the discussion we are having, but the way, for example, Intuit does it, in terms of capturing they have so many different hooks with which a small business enters the ecosystem. But once they have it in, there's so many different ways in which they monetize the same user. Many times those users don't realize they're paying the same company. Whether it's
Intuit is
for
the
invoice,
owner of QuickBooks. That's the one.
it is also TurboTax, also Mailchimp, right? So
Aha.
exactly. So if you're a small business, you think you're perhaps paying five different companies, but it's all the same. It's
Yeah.
kind of like become a toll booth where for these many different services, you keep paying the same company without realizing it.
Yeah. Yeah.
And obviously, it goes without saying, it's a fabulous business of that
There's
kind.
another VC wisdom, like it's not a wisdom, but like it's been preached like a wisdom. But I keep telling the founders I partner with that it's not a wisdom. Is that I want recurring revenue. Don't even bother with like one-off revenue with your SaaS customers, whatever. Dude,
Hmm.
that infuriates me when
Yeah.
people say that. There is a bunch of examples in our space and in other markets that when you actually have the chance to monetize onboarding fees, one-off training fees, infrastructure setup fees on top of your SaaS contract. So I'm not talking about instead of the SaaS contract. I'm
Hmm.
saying on top of the SaaS contract.
Yeah.
You get net negative customer acquisition cost.
Yeah.
You are able to generate positive cash flow that way. And so you're actually able to delay any type of fundraising for growth financing because your customers actually give you it's negative working capital is what it is
Indeed.
in a
Indeed.
software business. So they give you that kind of money to keep growing. That's the best recommendation I can give any
Yeah.
SaaS founder in construction tech is if you find these ways on top of the SaaS fee, exploit it because it's very cheap cash to grow.
Yeah. It's also, without going too deep into accounting basics, because recurring revenue businesses, you still have to amortize the revenue over each month. These business models, which have onboarding fees, training fees, etc., it's a great way to improve your P&L
Yes,
in a way which is very beneficial for the business overall.
indeed. Indeed. And in fact, it works even better if you're in an SMB SaaS
Hmm.
business, just because you are able to build more steady state one-off revenues like that, because you're just serving and onboarding, a larger portfolio of small customers.
Yeah.
Whereas if you do it with enterprise customers, 1 month might be a lot of cash, and then the next month, in the early days, that is,
Yeah.
until you are larger, and then you have a portfolio of customers. So,
Hmm.
so it even works better if you're in SMB.
Definitely. Yeah.
So, founders being net profitable in construction tech, not only possible but actually advantageous.
Yeah. Do you think, given the way the landscape has turned out in the last year, maybe a year and a half, we perhaps see a cohort of a cohort of founders that are trying to be net profitable more in proportional terms?
I think so, but I think it's unfortunately my reading of the market is it's not going to be a jump from 1% of them tries and now it's 50%. It's probably going to be a
Hmm.
jump from 1% tries and now it's 2%. Now,
Hmm.
if it's the 2% of projects that make a lot of sense that can go very high, then that's a super high
Yeah.
hit rate for us.
Yeah.
Yeah. How
Yeah.
about you? Do you get a similar sense in your markets?
I have a similar sense. As of today, I am holding myself back with a bit of skepticism, or I guess, to borrow a phrase that you use, Patrick, to pour some wine into the water, right? I wonder if, because I think so much of
It's actually the
VC.
other way. I like yours even better.
Water into the wine? Okay, so water into the wine. To pour some water into the wine.
I
Oh
like yours
yeah, I
better.
just realized exactly. Maybe I'm like improving the situation, right?
Yeah.
Okay. So so to pour some water into the wine, um, I wonder if you see a snapshot of how things exist today, things are coming together to encourage quite a few good behaviors or prudent behaviors, which could set firms up or founders up for net profitability.
Hmm.
But I'm also cautious that, hey, these factors could disappear, say 12 months, 18 months from now, and then we're back again to irresponsible behavior. We are like, hey, we did our bit, we made those sacrifices. Now we're again getting some easy capital, so let's party.
Okay. So
Yeah.
this is one of my most favorite topics. It's actually a short topic just because it's such a, I don't know, easy one to be opinionated on. So everyone listening, I can only tell you with life experience, you notice that money does not heal behaviors.
Mm-hmm.
Money amplifies behaviors. So if you start with bad behaviors, that's what you're amplifying if you give that person more money. In the context of net profitability, that means if your inherent behavior is to spend money and not be net profitable, and you give or you receive more money, that's the behavior you're going to amplify, usually, right?
Mm-hmm.
Money does not heal behaviors, it amplifies behaviors. That's like a very, very core point to your point, Shub. So if you have a founder that actually inherently believes, actually, I want to hear this example from you. We can't make it public, but so there's a unicorn founder from Asia that is
Mm-hmm.
building a cross-border business right now.
Yes.
And he told us, hey, I'm not going to raise until I have amount X of monthly net profit.
Yes.
Because in the previous company, he didn't achieve it. He raised a lot of money, got a unicorn, and it didn't end well for him,
That's
right?
yeah.
So what about that example?
I mean, it is quite fascinating. Again, I guess we can't share too much to protect the person's confidentiality, but so that founder definitely has had a very fascinating experience. In fact, that founder's case, even in their previous venture, they actually were, believe it or not, Patrick. So it was a firm that was net profitable before they raised their first venture round.
Oh, I did not know. Okay.
Yeah, they were net profitable before they raised their first venture round, and in fact, that founder went on to describe how raising venture capital created a very different sort of dynamic around what needed to be done to deploy the capital. As in, the founder felt a deployment pressure of
Wow.
capital within the firm.
This was
And
2017, 18, 19, 20, like that.
yeah, exactly, more or less. By the way, I just realized I said exactly and more or less. So, but anyway, so maybe it's either of the two or somewhere in between, right? So, um, and it was quite fascinating. So, what his feedback to me was that when faced with deployment pressure, he felt it would always lead to suboptimal outcomes for the venture and for himself. So he wants to not put himself under that deployment pressure again until he's certain how he will be able to deploy that capital in a way which will create value for himself.
So that's
Now,
old school venture. That's how it's ought to be done.
exactly. And again, a lot of people listening to this are wondering, hey, what do you mean deployment pressure? Obviously, if you're a venture, you have room to grow, you can deploy. Are you sure though? Can you deploy it in a way which generates value for everyone involved? We're not talking about
Exactly.
burning money, right? Again, if you go
Exactly.
to old school venture, and I think we are paying a lot more and more attention to this. If you treat every single dollar as investable capital and not capital to be burnt or expensed capital, and the objective is, if not in a horizon of 12 months, say 24 months, 36 months, that you're expected to generate a yield on it. If you hold yourself responsible, perhaps at a point you're not in a position to, for instance, deploy 10 million. But then if you're not, and then you forcefully deploy 10 million, you will destroy value. And then if you
So,
amplify that to 100 million, you'll destroy even more value.
so here's another framework. Today is the day of frameworks in net profitability discussion. Here's another one. Okay, the more experience you get, the more you realize this. There's 3 reasons why you can raise money, and not all of them are equally good. First one is to scale something. The second one is to prove something, and the third one is to test or discover something.
Mm-hmm.
Scale something, that's the function you're describing. That's to your point. I have or GitHub raising 150 million as a first round. I've proven everything there is to prove. And now I need to enter new markets or accelerate the growth because I'm absolutely certain my product works, and I have the right motion.
Mm-hmm.
So that's scaling it. That's a great reason to raise money. And by the way, just to call that out, scaling is not 50 to 100 million. Scaling begins much earlier. It's about what have I proven and am I certain of? And then scaling that to enter new geographies, new markets, cities, customer segments. But you know that your product works and your motion works. Second one is to prove something. Okay, so that can, for example, be I have a core product that works. I'm raising to scale that. And besides that, I have a hypothesis from earlier discovery that a new product line, a new service, a new financial product, for example, would be appreciated and I can sell that into my existing customers. That's a good reason to raise money.
Yeah, absolutely.
But to your point, only raise as much as you need to prove it. If you need 500,000 to prove it and you're raising 5 million, you are destroying shareholder value.
Yeah.
That's exactly your point. Now, the last one, discovering, I hate this so much. So in the US, in Europe, there have been examples, abundant examples, where VCs that were sitting on too much dry powder actually went to first-time founders coming out of universities that are, reputed, good universities, and they say to these people, so why don't you found? Yeah, but I don't have an idea on opportunity. No problem. I give you 1 million and you find it.
Yeah.
This is something I completely abhor. Like that to me is the worst side of venture capital. And I can't even blame the founder for taking the money at that point, because it's just a no-brainer to take it, because if you fail, it's a paid MBA. Thank you. I'll take it. No problem. Right? But to do that when you already have a business up and running and then you raise something to discover something, that's equivalent to a pivot. You should not be raising money for that unless you absolutely need it.
Yeah, I agree. Yeah. Yeah, so it's interesting. I mean, and it's really fascinating. We quite often forget that for most of the journey in a venture, and actually true for nearly all of the journey in an early stage venture, the founder or founders are the largest shareholders. So sometimes you also need to just zoom out and say, hey, what will maximize the value of as in the founder's own equity, right? So any unit of money you deploy, hey, that's also a piece of your own equity you're choosing to deploy. So are you getting a good return on that money? And sometimes it sounds innocuous or maybe a bit too mundane, but it's fascinating how things like these, it seeps into the mindset of how important, where you allocate your money and how you get your yields on top of it.
Very true.
Yeah.
In fact, Alec Hartman, founder of DigitalOcean, founder of Welcome Homes, we spent some time with Alec earlier this week, and he reminded us of that, is that the way he works with his team is that everybody knows one of the North Star metrics is share price. Why? Well, it's valuation divided by number of shares. So if you dilute and if you inflate the cap table a lot, your share price not necessarily goes up. Yeah, that's the denominator. So share price is a decent measure for what you are describing.
Yeah, absolutely.
It's funny, right? I mean, when we say these things, I wonder how many people are listening live right now, and they're like, "Oh my God, this is so obvious." Yeah, but the obvious things get forgotten so often. It's unreal.
Yeah. I mean, look, there are fabulous companies which are able to, for example, take 100 million or even hundreds of millions of dollars in a year, deploy it very effectively to get a good yield, to grow revenues, grow profits, grow the scale in a year. But if that doesn't describe what any of our listeners, or in general, at whatever scale, if it's not hundreds of millions, whatever scale of funding they have, then maybe it's that's the point at which you should maybe pause and revisit what you should actually be then investing or burning as part of the business. Because is it helping you get a good yield? If not in a 1 year horizon, in a 2-3 year horizon.
That's right.
That's in my opinion the mindset to have.
And on the yield point, it kind of almost closes the loop on why being net profitable allows you to dictate terms. So we have companies that are default alive because they are net profitable, and all of a sudden they do 5% dilution rounds.
Yeah, that's right.
It's an untold secret. It's something that hardly gets communicated. So I don't even blame, like, especially first time founders, but even second time founders who maybe haven't been on this journey, that they don't necessarily realize that is possible. It's
Yeah,
absolutely possible. It
yeah.
starts at Series B, is very likely at Series C. Why?
Mm-hmm.
Because investors at those stages don't have ownership targets anymore. They
Yeah,
drive a multiple on money business and deploying large tickets. While the early stage investors, well, they have to play a slightly different game, which is driven by ownership. So
yeah,
as you're at Series B, but definitely at Series C, if you're net profitable, 5% dilutions are absolutely possible. And
yeah.
that's another thing, right? So if you actually reverse engineer the journey of your business and
Mm-hmm.
how much you dilute to what outcome, your personal economics as a founder change completely if you dilute 4 times 5% or 2
Yeah.
times 20%.
Mm-hmm. Absolutely. Yeah.
I wanted to ask you one thing
Mm-hmm.
that actually came up during our conversation in my mind. You know, we sometimes as VCs are guilty of making the simplistic heuristic, oh, this company was founded in that year, it's a bit older, I'm not going to look at it because it doesn't
Yeah.
look like it has inflected. But
Yeah.
now, if you think about it in a net profitability context, couldn't it also be that those companies are more likely to be net profitable? And shouldn't we be
Very
taking more
likely.
look?
Very likely. And I must admit, I'm guilty of the heuristic you just
Me
described.
too.
Right. Um, yeah. You have a great point there. It might very well be a company of that sort. Yeah.
Maybe that should be the call out
Yeah.
to founders. If you have built such a business, net profitable, have decent growth. I mean, it does work without growth. I mean
That's true. Yeah.
that's also difficult. But like
Yeah.
2x year on year, net
Yeah.
profitable,
Absolutely.
write me an email.
Yeah. We'd love to talk to you.
And it's not a fashional thing. It's not like oh, money is not cheap anymore, so now it's net profitable. No. This is how it's supposed to be done. This is
Yeah.
how, that's why I call it old school venture. Every venture
Yeah.
in the 70s, in the 80s, in the 90s, in the early 2000s was built this way. Google was
Yeah.
net profitable at IPO. Amazon was
Yeah.
net profitable at IPO.
Yeah.
It's only been the last 15 years when we made money cheap that, we
Yeah.
kind of felt we don't need that anymore.
Mm-hmm. Mind you, those I think some of the founders listening to this may think, hey, but that was at IPO. Maybe this means that we can keep staying unprofitable at Series D or E. Keep in mind the valuations at which Amazon and Google went public were
Yeah.
much lower than. Actually, I'm not sure if they were unicorns. I think maybe not, or maybe Google was, but definitely not Amazon when they went public. But that's something also to keep in mind. So if you're assuming that, hey, you have runway to not be net profitable until a certain valuation, just because the IPO hasn't happened for a ceremonial, I mean, if you treat that as a ceremony or a milestone, hey, also look at the valuations those firms were at. They were profitable at a much lower threshold of
Yeah.
valuation.
Yeah. Yeah. So, I mean, what are the takeaways for Construction-Tech? Absolutely possible to be net profitable early on in Construction-Tech. B,
Mm-hmm.
especially if you find ways to monetize services, outcomes, transactions.
Mm-hmm.
C, multiple examples in our portfolio, outside of our portfolio, that we
Yeah.
can, in this format here anonymously, but internally we're doing it non-anonymously, that we can point to.
Yeah.
Bad behaviors get amplified by money, so build the
Mm-hmm.
muscle for net profitable early.
Yeah.
Anything else I'm forgetting?
I mean, try to get a good yield on all the money you deploy.
Right.
Yeah. If the yield
Fair.
is uncertain or negative or very low, revisit if that's a good expense to be burnt.
Very important. Dolphin
Yeah.
theory,
Mm-hmm.
gas station behavior,
Yeah.
and the 3 reasons to raise money: scale something, prove something,
Yeah.
discover something. Bad reason to raise.
Mm-hmm. Absolutely.
Okay. Do you have anything to look forward to next week?
Anything to look forward to? What a question. Spending more and more time with our portfolio, I guess in tune with our discussion, reminding a lot of them about the value of capital deployment, putting it in the right places, boosting profitability in the cases where those firms need that sort of discussion. Um, yeah, I'm also, I know I've had some very colorful views on AI. I'm seeing some interesting applications where AI and the traditional world sort of intersect. I'm curious to see how my views evolve on that. Seeing some interesting applications there.
Are all of them like embedded in vertical use cases?
Yes,
Okay.
and uh, again, maybe I can leave it on a cliffhanger.
Oh,
In one, combining applying AI in a way where I actually didn't realize that that sort of value could be delivered or would be relevant in that use case or in that market. So that was like a very unique, insightful learning for me.
that does sound something I need to pull the thread on with you in the next episode.
Yeah, I'll be looking forward to it. I mean, only looking forward to that part of it, not the
Ah,
whole discussion with you.
not me in particular. Looking at my calendar here, meeting a bunch of friends, VC friends and other
Mhm.
friends next week for a good get together. If you know me, that's something I do once a year. This one I actually look
Yeah,
forward to. So that's why
nice,
I'm doing it.
nice, nice.
Yeah. And Practical Nerds 14. Looking forward to seeing
Indeed, yeah,
you
looking
and
forward to that as well, or at least parts of it. Yeah,
thank. Okay.
all right, this was fun.
Yeah, likewise.
Yeah,
And I think, can't be spread enough the word that you can build net profitable and you should build net profitable.
yeah, absolutely.
Do it like the Dolphins.
Sounds like a plan to me.
All right, sir. Happy weekend.
Happy weekend, Patrick.